What is a temporary buy down and why should you consider it? If you are a buyer who's been looking for a home for the past few months, or if you're a real estate agent who's helping buyers to buy homes, you've probably come across the term temporary buy down or 2-1 buy down and you weren't sure what it meant. I'm going to explain what a temporary buy down is, how it can help your clients, and give you an example of how it works. So first off, let's talk about why we're in the position that we're in right now. During the past couple of years, the housing market has been red hot, and buyers often had to pay well above the asking price to get the house that they wanted and get their offer accepted. And it was all on the seller's terms. No seller paid closing costs, anything like that we're used to. And while that market is still really strong today, the buyers do have a little more room to negotiate. It's cooled off enough that we can negotiate better prices and terms for the buyers. Now, although you do have better negotiating power, you're also subject to much higher interest rates than we saw last year when the market was hot. So one way to get through this is to use a program called a 2-1 buy down and lower your interest rate temporarily so that you get a better mortgage payment for the first couple of years. And instead of asking the seller to lower the price on the home, you can ask them to pay for the cost of this 2-1 buy down. This gives you the opportunity to get the home that you want at a lower mortgage payment and to refinance later on when the interest rates do come back down. So what is a temporary buy down? This means that the interest rate is lower for the first 2 years and then it goes back to the actual interest rate. So let's say that we're using a 2-1 buy down. That means the interest rate is going to be lower for the first 2 years. That means the interest rate is going to be 2 points lower in the first year and 1 point lower in the second year. In the third year, it's going to go back to the regular interest rate. So for example, if the offer rate is 7%, then the first year it would be 5%, second year it would go to 6%, and the third year it would go to 7%. Now, how do we do this? We do this by putting money in an escrow account that supplements the payments for the first 2 years. Those funds are usually paid by the seller or the builder as seller paid closing costs. So I'm going to show you a comparison of a purchase with no buy down, a purchase with a 2-1 buy down, with a temporary buy down, and with a price reduction so you can see what the difference is. So in this total cost analysis, we're looking at a conventional loan with a purchase price of $400,000 and a down payment of 20%. Keep in mind that you can use this not only for a conventional loan, but also USDA, VA, and FHA, of course. And you can have a down payment that goes down to as low as 5% on a conventional loan. I'm just using this as an example. The rates and the cost, of course, can be different. It's going to vary in different scenarios. So let's take a look at the first column. This is our control. This is a $400,000 purchase price. That is the list price. 7% is the interest rate. No closing costs paid by the seller. I am including taxes and insurance that I've estimated in this payment here. Then if we go on to the second price, here we've asked for a price reduction of $7,250. So there's no difference in the interest rate. There's no additional points. This is just a lower payment. It actually gives you a lower payment by about $40 per month. And in the third column, we have a permanent buy down. Now, we haven't really talked about a permanent buy down, but basically what that is you use that money to pay down or buy down the interest rate as much as you can. That would reduce the interest rate for the life of the loan. So in this case, we're looking at a cost of about 2.3%, which is 2.3% of the loan amount. That's what it would cost to buy it down. And it's going to take it down from 7% to about a 6.37 interest rate. That is going to lower our payment by about that is going to lower our payment by about $133 per month. Now, the last option here is our buy down. So this is a 2-1 buy down. So that means that we are starting out with a 7% interest rate, but in the first year, we're going to have a 5% interest rate. Then it's going to go to 6 and then to 7. So in this case, the payment in the first year will be about $411 less. And in the second year, it would be $199 less. And then, like I said, in the third year, it goes back to the regular offered rate. I hope this helps. If you have any questions, if there's anything I can do, reach out. I'm here to help. Thank you.